What's up, you guys? So we're here for oneglancetrader.com, and in this video I'll be sharing with you two indicators that are showing extreme fear in the market, and instead of selling your stock, why you should be buying stock in this particular environment. And if you like the sound of that, all I ask for is that you smash that like button and don't forget to subscribe and hit that bell notification. I'm producing weekly videos about investing, forex, options trading, all that kind of good stuff. So I'd appreciate, if you join me on this journey. So the first kind of indicator or index that I want to go through is the fear and greed index. And again, if you Google the fear and greed index, it's on at CNN.com. And what it does, it measures market sentiment. And as you can see at the moment, we are now in extreme fear. And that kind of makes sense, with, inflation concerns, GDP concerns, the Russia situation, all those types of things. You can see why investors and retail investors are selling stocks, and you can see that in the Nasdaq, the S&P 500, small cap stocks, even big caps like Apple, Google. They're all starting to, get into corrections or bear markets and all that kind of different things. And I'll probably use this as the kind of thumbnail. If Warren Buffett's got the amazing quote of, be fearful when others are greedy, and be greedy when others are fearful. This is investing 101 straight out of Warren Buffett's playbook. And if you look at what Warren Buffett's doing, he's actually buying stock at this particular point, because he realizes that a lot of stocks are undervalued now due to this massive sell-off inside the market. And I'll go through one stock in particular, classic example of where revenues are up, profitability is up, but it's trading at such a low valuation where it becomes a bargain. And over the next 2 to 5 years, I'm assuming, or I expect that stock to double, quadruple in price, as well as they've got a sound business model and a great bright future. So, you can see that here on 15. Yesterday it was 16. A week ago it was 22. A month ago it was 37, and a year ago it was 51. So you can tell that we are going, down. And then on this particular site, you've got a graph that trends it over time, and you can see here that it's just continue to go down. And if you look at where it's been over the last couple of years, this was the coronavirus crash over here, and we're not that far away from it. We're not that far away from the apologies, coronavirus crash over here back in March 2020. And we all know what kind of happened over there after the kind of boom market after. And then we hit peak greed, and then we start to fall back down, and so does stock. So this is a very good index slash indicator to be using on if you think it's the right time to buy or to be selling stocks. This is an indicator that you should be using. The second one, which kind of correlates with this, is the volatility index, or the VIX. And what this does is, as the name suggests, it measures the volatility within the market. And when we say volatility, effectively what it means, the higher the volatility, the more stocks fall. And you can see here that we had this massive peak back in March 2020 of highs over 85. That's absolutely insane. At the peak of the kind of coronavirus pandemic, where we thought that the world was going to have to, the global economy was going to have to shut down. We were going to lose 5 to 10% of the population, and stocks crashed as a result. But then we worked out what happened when we kind of came out of that. Yes, we kind of got help from the Fed in terms of printing money and all those kind of different things, but we eventually got out of that, and we went on this massive bull run throughout 2020 and a majority of 2021. And what you can see here, then, as a result of that, the VIX declined. And what you're seeing now using the OGT gamma indicator is that we've got the short term and long term moving averages both green. The VIX is starting to rise, and this rise here. So the higher it goes, the more fear is there, and you can see that in an inverse correlation with the fear and greed index. So the kind of consensus is every time the VIX is above 30, and this is what this line is over here, is we normally see days, weeks of sell-offs really. And instead of selling, if you believe long term in the company and the holdings that you've got, or if you don't have holdings in a particular stock that you like at attractive valuations, this is the time to start picking up these stocks. And to prove why that is the case, I've got two things to kind of show you. Firstly, if I overlay the S&P 500 on the VIX, and if you look at times where the VIX jumps above 30, you've got this situation here where the VIX back in 2018 kind of recession of highs of 50. You can see that the S&P, again, this is a weak chart, so it's going to look very small in comparison, but there was a lot of pain in this situation here. We saw a downwards movement, and then it kind of started to recover. Then we see another spike above 30. Stocks declined. Then as the VIX went down, we started to climb back up and making newer highs when it was over here. And then you had the coronavirus pandemic, where you see that classic V shape of stocks absolutely tanking, and then the recovery as the VIX starts to decline. And we're seeing, if history is any indicator of what's going to happen, the long term of the S&P is it continues to make highs as time goes on. Now we're seeing the VIX over the last few weeks, especially in 2022, of the VIX being above 30, and you can see now that the S&P is starting to tail off. Now, how long will this continue? I don't know, right? It could be another few weeks, another few months of the VIX continuing to rise and the S&P continuing to fall. But now is the time to start buying up your favorite stocks that have good business models that you believe in the long term, to be able to, when the VIX starts trading up below 30 and starts declining like it has every single time. The key thing, what we don't know, is when is that going to happen. So cost averaging into your favorite positions, into your favorite stocks, because when the VIX starts to decline and the S&P starts to go up, we're going to see a massive move inside the market. And we saw it every single time that that the VIX started to decline. So if history is any indicator, every time we get these dips, we see the VIX above 30. And this is the moment that we're in now. When you look in hindsight, if you weren't investing, I didn't invest during this period over here, it may be difficult. Apologies, got this cough that I can't seem to shake. But you'll see here that if you are investing in this time, it is very hard to see stocks go down 5, 6, 10% every single day and continuing to buy the dip. But this is where a lot of people say buy the dip, buy the dip, buy the dip, but it's very hard to do inside practice. But hopefully when you can see these kind of indicators, and when history is that the S&P will recover as part of this eventually, once the Russia situation solves itself out, once the Fed starts increasing interest rates, and a lot of that stuff's kind of priced in of how much they're going to increase interest rates over how long periods. This is the time to start, or the accumulation phase of start accumulating stock. And you can do that by cost averaging in, selling puts below the current price to pick up some premium along the way. There's many tactics. I've got a lot of videos on the channel about how to do that, and I'll link to those in the description and in the top right hand corner. And then another classic example, and I talked about this a few weeks ago, about Meta, about Facebook. So Facebook, as you can see, has got absolutely hammered. Part of that is down to weak guidance on their last earnings call, and a lot of the stuff as well is part of the VIX and the fear and greed index being at all-time lows. Is Facebook or Meta is just can't find a bottom. It's just getting low after low after low. And what I wanted to show here um, is if you look at where their share price is at 195, and if you look at when the last time um, Meta or Facebook was at that level was around April 2020. So in the peak of the kind of recovery of the coronavirus outset, you can see here at this time their sales was 70 billion and their EPS and profitability was $6.39 per share. Now, if we look now at where the latest earnings, we're at 117 billion, right, compared to 70 billion. If you look at their earnings has increased by over 100% from 6 to 13 in that same period. So the share price at the moment is significantly undervalued if you look at what Facebook has done between 2018 to the last earnings back in at the back end of 2021. And that is just absolutely ridiculous in terms of where Facebook is currently valued. It's increased its revenues, it's increased its EPS. They've got the metaverse, you know, and that's going to be a massive thing. So that is not being factored in. No one cares about any of this stuff inside the market in this risk off environment. So, what am I doing in this environment? I am buying Meta shares. And another classic example, just very quickly, is PayPal. PayPal as well. If you look here, it's the share price got absolutely decimated. And the last time it was at this price again was in April 2020. Oh, I really do apologize. Sales were at 17 billion. Last earnings, sales are now at 25 billion. EPS was at last earnings around that was at $3.07. It's now at $4.60, and the price is continuing to tank due to external macro factors outside of the company's control. There's in the PayPal business model with PayPal, Venmo, number one, number two apps inside the App Store. Again, another company that is significantly undervalued. And what I'll be looking at is investing more into increasing revenues, increasing profitability kind of stocks on whole buying up those positions and then utilizing options as well to sell covered calls once I reach 100 shares of these particular stocks to generate more income to reinvest more into these as these start to recover. So PayPal and Facebook are just two examples. There is no bottom yet. We don't know how low they're going to go. So I'm not buying 100, 200 shares straight away. I'm buying 5 to 6 shares a week of this and averaging down my position, similar to how I do in crypto, investing around $200, $300 a week into Bitcoin and into Ethereum, and then ride the wave on the way back up. So I really hope you found this useful. Again, the key takeaway here is we need to be looking at buying stocks when the market is fearful and when the market is greedy, looking to either hold your position or potentially sell out of positions that have done particularly well in the kind of current environment. So really hope you like this video. On the screen right now is more information about this, and I shall see you guys in the next video.